is Introduction to Bookkeeping and Accountancy, Part 3. The important concept of accountancy. First one is business equity. Now, what is business equity? This concept implies that a business unit is separate and distinct from the owner or owners, that is, the person who supply capital to it. Based on this concept, accounts are prepared from the point of view of the business and not from the owner's point of view. Hence, the business is liable to the owner for the capital contributed by him or her. Example, I'll give you one example and then you'll understand. Half of the building is used for business office and other half of building is used for residence of the proprietor. It is that if the total rent of the building is 50,000, then only 25,000 will be deducted as drawings from the proprietor's capital. That is known as business equity, means only 25,000 will be deducted as drawings from the capital of proprietor. Second one is money measurement. This concept implies that only those transactions which can be expressed in terms of money are recorded in the books of accounts. Since money serves as a medium of exchange, transactions expressed in money are recorded and the ruling currency of the country is the measuring unit for accountancy. Example, if a business is having 5 computers, 2 tables and 3 chairs, the asset cannot be added to give useful information unless that are expressed in money terms. Means we'll write 1,50,000 for computers, 15,000 for tables and 2,500 for chairs. We cannot mention it as 5 computers, 2 tables, 3 chairs. We have to mention in the money matters. That is money measurement. Next is cost concept. An asset is recorded in the books on the basis of the historical cost, that is the acquisition cost. Cost of acquisition will be the base for all further accounting, future accounting. It does not mean that the asset will always be shown at cost. It is recorded at the cost at the time of its purchase, but is systematically reduced in the book's value by charging depreciation. Means, for example, if you are purchasing furniture of 3 lakh at the same cost has been recorded in the books. In case the market value goes to 1 lakh or 1,50,000, it will not be considered. Means you have to only write at what price you have purchased, that is of 3 lakh. Next is consistency concept. Any policy adopted for accounting should be continuous or consistent throughout the business and it not be changed generally unless and until circumstances demand. However, it does not stop my improvement of new technique, but that should be disclosed with a note. Means a company is adopting the fixed installment method for charging depreciation on its asset in the beginning, but it should be follow the same till the end of the asset is used, till the life of the asset it is. Means we cannot change that method in between. If you are using fixed installment method, you will charge that fixed installment method on your depreciation till the life of the asset is. Next is conservation. While recording the business transaction, we have to anticipate no profit but provide all possible losses. It encourages the certain secret reserves by making excess provision to prevent losses. The income statement may show lower income and the balance sheet overstates the liabilities and understates the asset. This policy of recording is asking the accountant to pay fees while writing the accounts. Means, example, closing stock of factory is 25,000 cost price and 35,000 market price. But while recording in the books of accounts, we will only make the book value of 25,000, means whichever amount is the lowest amount, we will consider that whether it is cost price or market price. Next is going concern. It is a basic assumption that business is going concern and will continue its operation for further. Going concern concept influences accounting practices in relation to valuation of assets and liabilities, depreciation of fixed assets, treatment of outstanding and prepaid expenses are occurred and earned revenues. Means we have to only mention whatever is the depreciation given assets and all. We don't have to. Assets are generally valued, means assets are only valued at the cost price. If it increases or decreases in the short period, it will be ignored. We don't have to mention that. Next is realization. Income is recorded only when it is realized, that is, either it is received or earned. Revenues are recorded only when sale are affected or the services are rendered. Sales revenue are considered as recognized while sales are affected during the accounting period, irrespective of the fact whether the cash is received or not. Example: if a company is getting order of sale of goods for 1 lakh in month of May 2017, but company is selling the goods, delivering the goods in month of May 2017 of 60,000, cash is received for the same in 60,000 in month of September. As per the principle of realization, sale is to be recorded in the month of June 2017. We got the order in month of May, but we have delivered goods in month of June. So in our books of accounts, we'll mention when we have delivered goods, that is in the month of June 2017. Next is accrual. Income is recorded when accrues, earned, and expenses are recorded when they are accrue, means become payable. All expenses and revenues related to the accounting period are to be considered irrespective of the fact the revenues are received in cash or not, or expenses are paid in cash or not. Means, I'll give you one example. A company is investing 1 lakh with a bank for 1 year. On 1st October 2015, bank has to pay interest of 10% on its maturity, that is 30 September 2016. Next is dual aspect. According to this concept, every transaction or event has two apex, that is known as dual effects. I'll give you one example. Akshay started its business with cash rupees 5 lakh. On one hand, the business gets the cash of 5 lakh. On the other hand, a liability rises, that is, the business has to pay Akshay a sum of rupees 5 lakh. This concept, which recognizes the fact of every debt that is corresponding and equal credit. On the basis of the entire system of double entry bookkeeping, this concept of accounting equation rises is asset is equal to capital plus liabilities. Next is disclosure. The accounts must disclose all the material information. The accounting report should disclose full and fair information to the related parties. The financial position and performance should be disclosed very honestly to all users. The financial position means the balance sheet of the business, and the financial performance means the business result in terms of profit or losses and income and expenses in profit and losses account. I'll give you one short example. Means disclosure means we have to only disclose whichever information is reliable and relevant for the authorized concerned people. We don't have to give any irrelevant or any wrong information or anything which is given wrong in your profit and loss. We have to only mention the proper, reliable and comparatively, which should be easily understood to the outsiders. Next is materiality. According to this convention, financial statements should disclose all material items which might influence the decision of the users of financial statements. Hence, any item which is not significant and is not relevant to the users need not be disclosed in the financial statement. Means anything which is wrong or which is not required, which is not important for the person looking outside the outsiders, that should not be mentioned in your books of accounts. Next is matching concept. According to this concept, revenues during an accounting period are matched with the expenses incurred during this period to earn the revenue during that period. This concept is based on accrual concept and periodicity concept. Periodicity concept fixes the time frame of measuring performance and determining the financial status. Means all the expenses which you are paying during the period are not considered, but the expenses or the adjustment on the basis of that are made as outstanding. Also, the provisions are made depreciation on fixed assets, bad debts, etc. relating to the accounting period. Thus, it matches means it should be the same match. If you are mentioning expenses and losses in your books of accounts, in your balance sheet, and same you have to mention in your books which you are giving to the outsiders for their references. Both should be same, both should be matching. Where they should not get two informations. One should be correct and one should not be correct. So you have to look whatever information you are providing to the outsiders should be correct and relevant to you. Thank you.